Hey, finance fam, welcome back to my channel. The recession fears have increased. People are feeling fearful. So, what I'm going to cover in today's video is what I'm seeing in the markets, what I'm seeing in the actual data, and give you a little bit more clarity on how you can attack the stock market going forward from here. Let's just dive right in. So, this is a daily chart of the S&P 500. Pulled this up on Koyfin. You can see that we had the big sell-off of 2020, and then the market kind of roared from there, as most of us know. And then we went into a bear market, meaning the stock market was down 20% plus from the highs here. And we had bottomed out in October of 2022 here. So essentially, this is the bottom that we saw. And in 2023, so far, it has been nothing but bull. It's been a strong market. So the S&P 500 rallied about 25% from the lows, and basically year to date we've been chugging higher and higher. We have recently seen the stock market pull back. We can see that here, and the past few weeks we've been in correction territory. We're down about 5% from the highs of 2023, and to be honest, that's not very alarming of a correction at all. I think that in the news right now, everybody's making it out to be like it's a very, very big deal. But to be honest, in the grand scheme of things, this total run higher, 5% correction is a little baby correction. Really, where we want to see the market come to is this 4,200 resistance turn support level here. So this is where it's a pretty big zone, 4,200 level, give or take. And we're looking to see if price is going to basically sell off and retest. That's where we're at. And if we do that, we'll be down almost 10% from the highs of 2023. That'll be a very, very healthy correction considering how far we've come. So I still don't think that that would be a very alarming thing to see price pull back to 4,200, in my opinion. So that's kind of the technical side of things, looking at the chart of the S&P 500 to give you an idea of where we are, where we came from, where we could go. But a lot of people are saying that we are going into a recession again. It's like we've gone through these ups and downs where the consumer was strong, and then as the consumer was continuing to be strong, people were saying this is going to end. We're going to see a big recession. The market will break the low of 2022. That never happened, right? And we never got the recession. Even Jerome Powell, Fed chair, has said that a recession has been taken out of the forecast. So here we are back to the big recession argument. Well, the fact of the matter is you cannot have a recession with a strong consumer and low unemployment. Of course, unemployment rates are always low. The consumer is always strong until they're not, right? And then that's when the data turns. But we do have to kind of look at a little bit of everything here to really get a gauge of where we're at with the consumer. Now, retail sales, the last data point that we got was actually really strong. That was the month over month data. If you go to the year over year data, you can see that this is clearly an acceleration in retail sales. Of course, things were stronger, but everything that gets a bit extreme and overbought or over exuberant has to eventually come back and normalize, right? And 2021 and 2022, there was still a lot of stimulus money in the system. But you can see that we kind of leveled out here year over year. Things slowed down after a long deceleration, but now we've popped back up in terms of retail sales, year over year. So with all of that said, the consumer is still showing signs of strength, even though there's been a lot of talk about savings being spent down. And this is where I get a little bit concerned about the narratives that are being put out there, because we have to look at different parts of the data to really get a good look at everything. And so what a lot of people are referring to is US personal savings. So personal savings basically spiked, and then we saw a decline, and essentially the narrative now is that consumers have ate into their excess savings and there's no more excess savings. So if you believe that narrative alone, then yeah, things look kind of scary, especially as student loan payments are about to resume. But if we know a little bit more and look at a little bit more data points, we can take a peek at something called checkable deposits. So, checkable deposits, which is the top panel, we can see that since 2020, this has been increasing and it's still way above pre pandemic levels. And checkable deposits are essentially money in your checking account or money that can be basically liquidated and spent very quickly, immediately. So what happened was the Federal Reserve took the six withdrawal limit off of savings accounts, high yield savings accounts specifically. There used to be a rule that you could only withdraw from high yield savings accounts 6 times in a given month. Well, the Fed changed that and basically took that away during COVID so that people could make as many withdrawals from their savings accounts as they wanted to. With this rule changing, banks were reporting those high yield savings accounts differently. Instead of reporting them in the US personal savings category, they'd be being reported in the checkable deposits category because you could get the money out basically right away. And you'll notice the rise in checkable deposits coincides with the decline in US savings. Now, that's not to say that savings didn't get spent down. Whatever was left and being categorized as savings, it looks like it's been spent down. But looking at checkable deposits, there's still plenty of cash in bank accounts, apparently. Also, to add to that, we've got money market mutual fund assets at $5.6 trillion now. If we look at what they were during the pandemic in basically 2020, we look back at 2020, we can see that money market mutual funds have continued to rise since 2020. And there's even been a sharp increase in recent quarters of money going into money market mutual funds to get paid interest. We can even look at a huge bank, Bank of America, right? One of the top banks in the US behind JP Morgan. They, in their latest earnings report, showed us an actual visual of what deposits look like. They have checking deposits and non-checking, aka interest-bearing deposits. And you can see that there has been a drawdown in deposits. It's gone down, but look at how much higher we are from pre-pandemic levels. So something like this does coincide with the other data in checkable deposits. So all of this being said, we have gone from basically being at extreme greed just 1 month ago to being neutral. Last week we were kind of close to the fear zone, but we're bouncing a little bit, so that is kind of changing. But you can see just a month ago we were experiencing extreme greed. So what this is kind of telling us is that this is aligning, the market is pulling back. And of course, as we know, nothing changes sentiment like price, and price selling off is going to change sentiment. Everyone is now anticipating recession, especially global recession, because other countries aren't doing so hot. Germany's in a recession. The Chinese economy, which is a very important part of even, US corporate earnings, that is not doing well. They are in recession. And there are other parts of the globe that are seeing really slow economic growth. But the US still kind of has this carve out situation right now where it is so much stronger than the other countries. The question is, does the global weakness really start to trickle down into the US economy? And that is a risk that we're still waiting to see play out. So I came across a Twitter argument that I thought was very, very worth sharing. We've been hearing a ton about interest that consumers are paying. Interest payments have gone up significantly, and that's true. But again, you have to look at the greater picture to really get a gauge on how this is affecting the consumer. So Michael Cantro basically posted this chart. I don't know if I'm saying that name right. Sorry, Michael. But he posted the non-mortgage interest payments. So think about credit card interest and, other types of variable rate debt like that, personal loans, etc. So non-mortgage interest payments have spiked, and we all expected that. We've felt it, we've heard of people having to pay more interest on their credit card debts. We've heard of people dealing with HELOCs, home equity lines of credit, that they didn't think that the rate was going to go up so high, and it's a variable rate, and now they're dealing with it and paying more interest. So higher interest rates have been hitting people's pocketbooks for sure. There's no denying that. But there were some interesting replies that I really wanted to dig into. Bill, I don't know Bill personally, but I follow him on Twitter, and he said, "I'm sorry, but this chart is just misleading. Here's the better chart." And he says, "Households are just fine." And he posted this chart, household debt service payments as a percentage of disposable income. And you can see that it's still below pre-pandemic levels. So the household debt service ratio is basically, it's using the mortgage debt service ratio and the consumer debt service ratio. So those are the main types of debts that are being considered when looking at this ratio. So somebody replied to him and said, "I'm sorry, but that chart is also misleading." You gotta love Twitter wars, right? Over the economy and recession. They're just so entertaining. He said, "Here's a good one. Take out mortgages that we know are not an issue." Basically, he's saying that we need to be looking at consumer debt, or debt X mortgage debt, because we know mortgage debt is like so good right now. People, in terms of their mortgage payments as a percentage of their disposable income, extraordinarily low, looking at it as a whole. And so he's saying you don't want to look at a number that includes mortgage debt, because of course mortgage debt is not a problem right now. And so he posts this chart, which is the personal interest payments as a percentage of disposable income, which has gone up. Totally get it. Understand that. We know that, interest payments have gone up for the consumer. But then it gets even more interesting. And Bill hits him with the financial obligations ratio, which basically is everything. Like, this is going to be including mortgage payments, consumer debt, rent, car leases, property taxes, blah, 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 you name it. And that is even said here, the financial obligations ratio is a broader measure than the debt service ratio. It includes all of these things. So this is straight from the Federal Reserve's website, basically telling us how to interpret this data. And so we go back to that and we see again, below pre-pandemic levels. Debt service ratios are looking really good, even still, with higher interest rates and higher interest payments. And so this person replies, TXMC says, "Be honest about the data. Mortgages are the biggest slice of consumer obligations, and we know that they aren't under pressure." And he's right. Mortgages are not under pressure. Borrowers are okay there because there's a lot of equity, low interest rates locked in on most mortgages. So any aggregate measure of debt stress that includes mortgages will naturally look quite good. And then in my mind, I'm thinking a certain thing. And then Bill hits it and says exactly what I was thinking, saying, mortgage payments being fixed at low rates is the crux of the whole thesis of why U.S. households are positively geared to rising interest rates. This person proved the point that I was thinking when they said mortgage payments are not an issue and they're the biggest part of the consumer liability, right? And balance sheet. And it's like, well, you just proved our point. Bill and I's point. I'm siding with Bill on this. So it's like, you just proved our point. If mortgages are going to be the biggest part of a consumer balance sheet, and they're in good shape, and debt service ratios for mortgages are extraordinarily low, that is what is setting the consumer up to be resilient, to stay a little bit stronger than people think. So taking that out of the equation is actually skewing everything. And Bill continues to say, it's the single biggest liability for US households, but you want to ignore it. And I cannot agree enough with Bill on this. You can't ignore that. When we're talking about a balance sheet, you can't just pick and choose. You have to look at, net worth and the balance sheet in general. So TXMC replies and says, he's not saying to ignore mortgages. I said it isn't the focus of the story for the very reason you gave. Existing mortgages are not impacted by interest rates. So basically, basically he is saying, why would you ignore the fact that even breaking out consumer debt being an issue in interest payments, why would you ignore that? And Bill replied and said, I think you're overly focusing on a tiny sliver of 4.7 trillion of consumer debt and not even talking about or comparing it to the assets, 150 trillion in assets plus ongoing annual employment income of 12 trillion. And then he gives the chart here. So I really, really loved this argument between Bill and TXMC. I totally get what TXMC is trying to say here, but I think Bill nailed it in the way that he replied, in the data that he used. This is the crux of the issue. A lot of people are swimming in assets still. They're swimming in home equity. They're swimming in assets in their brokerage accounts. We can even look at this data from the Federal Reserve showing, net worth over time. This goes to just Q1 2023, but net worth has been improving since the pandemic, and it continues to actually improve. It's actually rebounding from a slight decline. So what is my point in all this? You have to be very careful right now because there is a lot of data cherry picking that can be happening right now, whether it's the savings spend down, whether it's the consumer credit card debt rising, whether it's the consumer interest payments, right? A lot of those things can be pulled out and you can create a narrative around them if you want to. But when you look at the data set as a whole and you're looking at the consumer as a whole, assets as a whole, liabilities as a whole, you get a much different picture, right? It's maybe not as doom and gloom. Look, I'm not saying things are great. Inflation's eating into pocketbooks of consumers, absolutely. And not all consumers are doing well, but that's always been the case. We've always had people that have disposable income and don't have disposable income. So nothing's changing there. In fact, things are better than they were in terms of balance sheets across the board with consumers generally, even lower income consumers. This is an interesting chart from the Federal Reserve showing disposable personal income trends. What we want to pay attention to is the bottom quartile, right? We don't care about the really wealthy people. We want to see how the lower income individuals have fared in terms of disposable personal income. And they actually had the biggest boost since 2020. And other things that have helped with that have been things like tax credits. Tax credits were expanded, increased over the past few years, and that was a big help. So with all of that said, I just want you to be very careful where you're getting your information from, who you're getting your information from. Just double check it, fact check it. So looking back at the S&P 500 and, the risks that are out there, are we going to go into recession or not, yada, yada. I think that it's important to just keep your eye on your long-term goals. I know that if the market pulled back any further from here, for me, I'm looking at that as a significant buying opportunity. There's a lot of cash in money market mutual funds that would probably love to see a correction or a deeper sell-off in stocks to be able to put some capital to work. So that's another thing that we need to be thinking about that could actually maybe keep the S&P 500 correction a bit more shallow than people expect. Just something to look out for. But essentially, corrections that go deeper from here, to me, are going to be likely buying opportunities. All right, finance fam, let me know if you like this video, the charts, all the data, all of that fun stuff. If you learned something new, if you want me to expand on something, hit the like button if you enjoyed it. Comment with anything you'd like to see me talk about more, any questions that you have, and I'll see you in the next video.